Hello, we are going to talk about chapter 14. This is our last chapter. So we almost see the light at the end of a tunnel. Okay, so in this chapter, okay, let's see, we'll talk about the concept of the cost of equity, the cost of debt, and the cost of preferred stocks, weighted average cost of capital, divisional and project cost of capital, company valuation with the WACC, flotation costs and the weighted average cost of capital. Okay, so first one, let's talk about the cost of equity. So what is the cost of equity? Okay, so cost of the equity is actually, you can think of this as a percentage, as a return, okay? So this is the return required by the equity investor, okay? So if you invest in the shares, the stocks, right, you are basically purchasing the ownership of the firm, right? So the cost of its equity is the return required by these equity investors. So there are two major methods to determine the cost of equity. The first one, we are using dividend growth model, and this dividend growth model is not new to you. Okay, the second one is the stock market line or CAPM model. Okay, so for this one, this is the dividend growth model. Okay, if you still remember in the previous chapters, we have learned about the price, the dividend, right? The relationship between stock price and the dividend and the returns and the growth rate, right? So your price of a stock equals to the dividend. So the expected dividend, okay, D1, which is the subsequent period, right? Divided by the return, expected return of the equity from the investors minus the dividend growth rate. So in this model, we are assuming that the dividend will grow at a constant rate, G, right? So hopefully you can still remember this formula. So then, because what we care about is the return of the investors, right? The RE. So we solve the RE using the equation above. We get D1, so divided by P0. P0 is the current price. D1 is the dividend you are going to receive at the end of the first period. And the plus G is the growth rate. Okay, so this is the dividend growth model. Okay. In this example, okay, let's assume company is expected to pay a dividend of $1.50 per share next year, right? Next year. So this is really important. Okay, this is really important. Next year. So they're going to pay a dividend of $1.50 next year. So this tells us D1 equals 1.25. Okay. There has been a steady growth in dividends of 5.1. So G equals 5.1%. The market expects that to continue. The current price, right? Here, the current price. So tells us P0 equals $25. Okay, so now let's calculate the cost of equity, RE. So that equals D1 divided by P0 plus G. Okay, so that equals $1.50 divided by $25 plus 5.1%. So that equals 11.1%. Okay, so that's how we, using the dividend growth model, we can calculate the return of the equity investors on the stocks. So one question, a fair question would be, how can you know the dividend growth rate? Right, that's a very good question, right? In the previous question, that information was given, but how can we know the dividend growth rate? Okay, so one method is to use the historical average, right? One method is to use the data happened in the previous years, right? So now take a look at this. So this record shows me that from the year 2011 to the year 2015, and the information provides the amount of dividend provided for each year. Okay, so we're going to rely on this to estimate what is the growth rate. Okay, so now you can say, well, I can calculate the percentage of change. Okay, so in 2012, right, I use the dividend for 2012 minus the one in the previous year, divided by the one in previous year, I get a growth of 5.7% for 2020, for 2012. So we use a similar approach. So now you take a look at the year of 2012 and 2013. So for the year of 2013, the dividend is 1.36 minus the one last year, 1.3 divided by 1.3. So in the year of 2013, the dividend growth rate is 4.6. So you keep repeating the same calculation. You can calculate the percentage dividend, the dividend change in percentage. Okay. Now, if you just take an average of the data, so you have on average, you have about 5.1% growth rate, okay? 5.1 growth rate. An alternative approach to estimate the growth rate is to use the retention ratio and return on equity. So if a company has a stable return on equity, right, ROE, and they have a stable dividend policy, that means the dividend payout policy is very stable, the same over the years, and they are not planning on raising new external capital. So the growth rate is actually can be calculated by retention ratio times ROE, return of equity. So in this example, they are expecting the ROE is 15%. So the dividend payout ratio is 35%. What does this mean is, if you have a net income of $100, okay, $35 will be paid out as dividend to the shareholders. You still retain $65 in the return earnings. So that's the paid out ratio. If management is not planning on raising additional external capital, what is the XYZ growth rate? So growth rate equals retention ratio, okay? Retention ratio here. So that is 65%, right? So what's the percentage of the income kept in the company in return earnings? Well, you paid out 35% as dividend to the shareholders. So the retention ratio is 65%. 1 minus payout ratio. And times ROE, 15%. So its growth rate is 9.75%. So that's the kind of the two methods. The first one is to rely on the historical data, right? You do a calculation year by, you compare 2 years, calculate the dividend growth of each year, and then you take the average. The second one, if facing all these assumptions, you are able to use this formula, retention ratios times return of equity. What are the advantages? Well, it's pretty easy to understand and use. This advantage, it only applicable to the companies that pays dividend, right? Because you use dividend growth model. If they don't pay dividend at all, how can you use this model, right? And remember, in that model, we assume the dividend growth rate is constant. The dividend grow at a steady rate. If that's not the case, you cannot use this model. And it's actually very sensitive to the estimated growth rate, right? Because the RE equals D1 divided by PU0 plus growth rate. So it's very sensitive to growth rate, right? If your growth rate increases 1%, your cost of equity will also increase by 1%. And this model didn't address the factor of the risks. Okay, let's take a look at the SML approach. Okay, so we are in the last chapter we have talked about the stock market line, right? So what is involved here is the risk-free rate (RF), market risk premium. So this is the expected market rate minus REF. That's the market risk premium. And systematic risk of the asset, beta. So your expected return of the investors will be first time value of the money. So that's the risk-free rate inflation, right? Plus you are compensated by taking risks, right? So beta times the market risk premium. So here's one example. Suppose your company has equity beta of 0.58, which is good because this is a risk that's lower than, I'm sorry, I should not say this is risk. This is good, but the risk of the stock is only 58% of the market systematic risk. And the risk-free rate is 66.1%. And the market risk premium is 8.6%. What is your cost of equity? So you use RF 6.1. So this is RF 6.1 plus 0.58. So this is my beta. Okay, and then times the market risk premium minus RF. Okay, so all the information are provided. Risk-free rate is 6.1%. Your beta is 0.58. And the market risk premium is 8.6. Okay, so then I can calculate that the return of the equity is 11.1%. Okay, so now you can see that we use two different models. We come up with similar results, right? So you probably should feel pretty good about the result, right? Because you try to use two different methods and all pointing to the same number. So you should have more comfort. So what's the advantage of the SML CAPM? Well, it does address the risk, systematic risk, using the factor beta. Well, it applies to all the companies as long as that beta information can be computed. Disadvantage. It's challenging to estimate the market risk premium, and it's constantly changing. And also, you have to estimate beta, right? The beta, the systematic risk, is not a steady number. It's also changes all the time. So ultimately, under this approach, we are using the historical information to predict the future, right? So this historical information might not be always reliable. So here's one example. Suppose our company has a beta of 1.5. The market risk premium is expected to be 9%, and the current risk-free rate is 6%. We have used the analyst's estimate to determine that the market believes our dividend will grow at 6% per year, and our last dividend was $2. Our stock is currently selling at 15.65. Okay, we are going to use two methods. The first one is the dividend growth model. Okay, so what is my expected return on the equity? Okay, so that'll be my D1 divided by, sorry, I need to do a better job with writing down the value of D. Okay, just give me 1 second. I'm trying to fix this part. Oops. I don't know why I cannot use this eraser. But anyways, so let's see. Okay, so here RE equals D0 divided by P1, okay, plus growth rate. D0, D1 P0. What's the current price? Our stock is currently selling for 15.6. 15.6. And what's my D1? D1 is the dividend a year after, right? So what is, okay, so our last dividend was $2, okay? Our last dividend was $2. So the one after this will be, so our last one, this is D0 equals 2, right? So now you have 2, okay, $2 times 0.1 plus 6%. Okay, so previously it's $2, but D1 will be year after, so that will be 2 times 1 plus 6% divided price and plus the inflation plus the growth rate. What is the growth rate? 6%. So this one is gonna be 2.12 divided by 15.65 plus 6%. Okay. So that's gonna be my return of the capital. Another way you do it, you use stock market line, right? In this case, your RE equals RF, risk-free interest, risk-free rate plus beta, the systematic risk minus market risk premium. Okay, so what is RF? RF is the risk-free rate, 6% times beta 1.5. 1.5 times market premium. Market premium is expected to be 9%. So this one is gonna be 19.5. Yeah, 19.5. Okay, so you can see you have two methods to calculate cost of equity, right? So don't be confused with others. We are only calculating the cost of equity. Okay, so let's see. Okay. So when you use SML, so 19.5%. If you use DGM, the dividend growth rate model, so it's a 19.55%. So you can see when you compare the two, one method leads to a result of 19.5, the other one leads to 19.55. So it's pretty close, good estimate. Okay. Now let's shift the gear. We talk about the cost of debt and the cost of preferred stock. Cost of debt. The cost of debt is the required return on your company's debt. Okay. So you have a debt in your company there. What is your expected return for that? We really focus on the cost of long-term debt or bond. Okay. The required return is best estimated by computing the yield to maturity on the existing debt. So this is nothing new, right? You in the previous chapters, you have been calculating what is the yield to maturity, right? What's the discount rate, right? Normally, you did this calculation in the context of a bond, right? Of a bond. You may also use estimate of current rates based on the bond rating we expect when we issue new debt. So the bond ratings will also give you some information, right? The ratings, AAA ratings means this is a good investment, right? So, and how that would, affect the rate. So here's one example. Suppose we have a bond issued currently outstanding that has 25 years left to maturity. The coupon rate is 9%, and the coupons are paid semi-annually. The bond is currently selling for $908.72 per 1,000 pounds. What's the cost of the debt? Well, in this case, N equals 50. Why? Because the bond is outstanding for 25 years and the coupons are paid semi-annually. So 25 times 2, that's 50. The payment, you are paying, number of payment. So $1,000 bond, right? Coupon rate is 9%. So this is all from previous chapter. So your annual payment would be 9% times 1,000, so $900. Okay, $90. Sorry, 9% times 1,000, so $90. But you're gonna make the two payments, right? So each payment would be $45. Your future value, you're gonna get your face value back. So that's 1,000, and your present value is the price you paid, negative 908.75. So when you compute the yield to maturity, that is 5%. So the yield to the maturity would be 5% times 2, right? Because whatever you are calculating there in the calculator is based on semi-annually. The yield to maturity is based on annual, so times 2, so 10%. Cost of preferred stocks, right? We have talked about the common stocks, right? What about the cost of preferred stocks? Okay. Normally, preferred stocks will follow a constant dividend, right? Every period. So preferred stocks, shares often will pay a constant dividend from year to year. And you can expect the dividend to be paid for each period. Okay, so preferred stock is annuity. So we can take the annuity formula and solve RP. So it's straightforward. You have a constant dividend for going forever and divided by your current price. That will be your cost of preferred stock. So here's one example. Your company has preferred stocks that has an annual dividend of $3. If the current price is $25, what is the cost of preferred stock? So use the dividend, annual dividend, $3 divided by the current price, $25. So it's 12%. Okay. Now let's introduce the concept of the weighted average cost of capital. So we can use the individual cost of capital we have computed to get our average cost of capital for the firm. The average is the required return on our assets based on the market's perception of the risk of those assets. The weights are determined by how much each type of financing we use. Capital structure weights. Okay, so let's use E stands for the market value of the equity. D stands for the market value of the debt. V is the market value of asset, also D plus E. Weights. Well, the weight for the equity would be E divided by V. Similarly, the weight for the debt would be D divided by V. So in this example, suppose you have a market value of equity equal to 500 million and the market value of debt of 475. So equity fair market value 500, fair market value of debt 470. In total, the asset value would be 975. So if I use 500 divided by 975, I get the weight for equity is just over 50%, 51.28%. And the remaining percentage is the weight for the debt. So D divided by V equals 0.4872 or 48.7%. Impact of taxes. We are concerned with the after-tax cash flow, so we need to consider the effect of taxes on the various cost of capital. One thing when you understand taxation is that if you incur the interest expenses, okay, to fulfill the commitment of your debt holdings, well, you have to pay interest, and that interest is deductible from your income from a tax perspective. So this reduction in tax reduces the cost of debt. So the cost of the debt, the return is actually equals the RD divided times 1 minus T1. The dividend, they are not taxable, so therefore they don't have any tax impact, right? Because we don't, the dividend are not taxable, okay? From the company's perspective, right? Of course, dividend is taxable from the perspective of the recipient, but the dividend are issued by the company, it will not affect the cost of equity. So now to know the weighted cost, so now to know the weighted cost, the cost of capital. So first, what is the weight for the return for the equity? So the weight on the equity times the return of equity, the return of the equity, and the weight of the debt times the return of the debt or the cost capital, the cost of debt, right? And note there is a shelter, tax shelter 1 minus TC, which is the tax rate of the company. Okay. And now when you replace your weight, right, WE, so that's equals E over V, WD equals D over V. Okay. So that's how can you calculate it? The weighted average cost of capital. So you want to know what's the cost of debt and what's the weight, what's the cost of equity, what's the weight. Put them together, you get a cost of capital. Example, we have equity information that's $50 million per share. Each share is $80. The beta is 1.15. The market risk premium is 9%. Risk-free rate is 5%. The debt information, the $1 billion in outstanding debt, it's the face value. Current quote price is 110. Coupon rate is 9%. Semi-annual coupon payment, and 15 years to mature. And the tax rate is 40%. So in this example, what is the cost of equity? Well, I can use the CAPM model. So I use RE equals RF plus beta times market return, market premium. So we get the risk-free rate is RF 5%, the beta is 1.15, and the market risk premium is 9%. So we calculated the cost of equity is 15.35%. What about the debt, right? The debt, it's a bond, right? So you go with, well, 15 years maturity, semi-annual, so A equals 30. And right now the price at 110, so the price value is negative 1100. The payment is 9%, and the face value is 1000. So therefore, the payment would be 1000 times 9% divided by 2, so $45. And the future value would be the face value, that's $1000. So when you compute the interest, you get a 3.9268. And you multiply by 2 because it's semi-annual. You get 7.854%. And don't forget, the interest expenses can help you deduct tax cost. So therefore, the return cost of debt times 1 minus the tax rate. So now it is 4.712%. Example, what are the capital structure weights? Okay, so in this case, you have 50 million shares, each one is $80. So in total, you have $4 billion equity. And the debt is 1 billion. And so it's issued at 1.1. Okay, so there are 1 billion shares. Each share is issued by 1.1. So there is $1.1 billion debt. And the total asset, so equals total equity plus total debt. So that's 5.1 million. And I can calculate there are 78.43% of equity and 21% 21.57% for the debt. What is the WACC? Well, I'm using the weight carefully. So this is for equity, WE, and this is for the debt, WD. Okay. And these two numbers we calculated in the previous screen. So the weighted average we calculated 13.06%. Okay. Using the WACC as our discount rate is only appropriate for projects that have the same risk as the firm's current portion. If we look at the project that is not the same risk as a firm, we need to determine the appropriate discount rate for the project. Dividend also often require a separate discount rate because they have different level of risk. So in this example, what would happen if we use WACC for all the projects regardless of the risk? So if we assume that WACC is 15%, now, okay, the required return, AB, right? This is all acceptable. The pure play approach. So you have to first find one or more companies that specialize in the product or service that you are considering. So that would give you a better starting point. And you have to compute the beta of each company, take the average, and use the beta along with the CAPM model to find the appropriate return for a project of that risk. So it's often difficult to find the pure play companies. Subjective approach. So you want to consider your project, the risk in the framework of the whole world. If the project is more or less likely than the firm, you use what the discount rate greater, okay, or less than the WACC. You may still accept project that you shouldn't and reject the hypothesis. You should accept it, but your error state should be lower than not considering differential risk at all. So this table shows the risk level is connected to the subjective approach. If it's very low risk, you go by the average WACC minus 8%. Low risk minus 3, same risk as a firm, that's the WACC. High risk WACC plus 5%, and very high plus 10%. Company's valuation with WACC. So you may remember this formula, the cash flow from asset, CFA. So that equals EBIT plus depreciation minus tax, right? And minus net change of working capital minus capital spending. Okay, so the taxes is approximated in this case, in this model, by EBIT times tax rate, okay? So this model is slightly different from the ones you have learned, because it used to be EBIT and the taxes are separate in that equation, okay? But in this case, the EBIT and the taxes are combined through the tax rate. So the comments on this company's valuation. So the adjusted cash flow from the asset is calculated as though the firm was 100% equity financed. And the EBIT times the tax rate are used instead of actual cost, right? So this is the adjusted taxes. Let's take a look at an example. Goodies Inc. currently has EBIT of $200 million per year. The CEO expects the EBIT to grow at 10% per year for the next 5 years and 5% thereafter. She also estimates the company's WACC to be 12%. The company's tax rate is 40%. Depreciation is 12.5% of EBIT. Changes in net working capital is 8.5% of EBIT, and the capital expenditure 24% of EBIT. What is the value of the firm? Okay. So in this table, in the middle one, you can see that we are trying to calculate CFA based on the EBIT depreciation, adjusted taxes, changes in net working capital, and net capital spending. Okay. And you're gonna do a present value. So once you calculated CFAs, you're gonna do a present value. So that value is turned out to be $1,932.60. Okay. Flotation costs and the weighted average cost of capital. What's the flotation cost? Well, the required return depends on the risk, not how the money is raised, okay? And the cost of issuing securities, such as stocks and debt, cannot be ignored here. So the basic approach is we'll compute weighted average flotation cost. Use the target weight because the company will issue securities in these percentages over the long term. So this is one example. The company is considering a project that will cost $1 million. The project will generate after-tax cash flow of $250,000 per year for 7 years. The WACC is 15%. The firm's target debt to equity ratio is 0.6. The flotation cost for equity is 5%, and the flotation cost for debt is 3%. What is the net present value of the project after adjusting for the flotation cost? So first, let's see the relative weight of the debt and equity. Okay, based on the debt to equity ratio 0.6, for every 10 equity, there are going to be 6 debt, 10 equity. So 6 out of 16 versus 10 divided by 10. Okay, so we calculated the weight for the debt is 37.5%. And the weight for the equity is 62.5%. Okay, so now what's the weighted average flotation rate, right? So that's going to be, these weights are here. So 4.25%. The true cost is not 1 million, right? The 1 million is just the cost you are issuing, but it's also cost you money to issue these things. So what happened is you're going to use the actual cost. The cost is 1 million minus this 1 million is the cost other than the flotation cost. So this is the percentage of the non-flotation cost. So the true cost is $1 million, 44,366. And we can calculate the present value of the future cash flows using the financial calculators to be just over $1 million, 40,105. So your net present value is the difference between the two. Your present value of future cash flow minus your cost. So that's a negative $4,281. So this one should be rejected. If you take a look at this number, if you do not consider the flotation cost, this one will be 1 million. So you're going to have $40,000, $105 of the positive NPV. So you probably will take this result. So you can see it's very important to include the flotation cost in your calculation. Otherwise, the result may be different. Okay, so that's it for today. Thank you for watching.